Buenas tardes, bienvenidos una vez más, esta vez antes de tiempo, jueves por la tarde, 4 de la tarde, nueva entrevista de DRACO TV, como sabéis, pues con cierta frecuencia, probablemente una vez al mes, vamos haciendo entrevistas pues a inversores, analistas, a CEOs que pensamos que pueden ser interesantes. Y en esta ocasión hemos pensado en Chen, que es un empresario y analista asiático que vive en China, pero que invierte y que busca pues, compañías de elevada calidad. Y le hemos invitado pues, a esta entrevista en fechas ya entrando en Semana Santa porque pensamos que puede ser interesante, ¿no? Por tanto, a las 5 se va a conectar, perdón, a las 4:05 es la hora que hemos quedado con Steven para que se conecte. Por tanto, bueno, estamos abiertos, sabéis, nos podéis dejar comentarios para decirme quién os gustaría que trajéramos para entrevistarlo, qué personas, qué inversores, tanto españoles como internacionales, qué gestores, qué analistas, etcétera, ¿vale? Por tanto, dejármelo en los comentarios del vídeo, podéis contactar por Twitter, por YouTube, por email, info@dracoglobal.es y podéis sugerir quién os gustaría que trajéramos. Mario, ¿qué tal? Buenas. Mario nunca falla, siempre en los directos. ¿Qué tal? ¿Estás preparando alguna tesis de inversión nueva, Mario? Cuéntame un poco mientras esperamos aquí a Steven que se conecte. Estoy tratando de traer a otros, ya tenemos a Steven preparado, ¿vale? Si os parece, pues vamos a empezar. Le voy a dar entrada y le voy a agregar a la transmisión. Steven.
Hi, Quinn. How are you?
Can you hear me well?
I can hear you well. How about you?
It's okay. Okay. So thank you for your time because I think that right now it's 12 in the night. Or what time is there?
It's 10 o'clock in the evening. It's okay. I mean, you know, with the lockdown going on here in Shanghai, and we don't differentiate too much about days and nights, you know.
Okay. So, well, here in Spain, today is a mid-holiday day. Maybe it's not best it's not the best day to do that, but because people it's moving to other areas of the country for just to spend 2-3 days out. Okay, but well, I think people are going to connect during this direct. As you know, for all the people, you can connect to the live. Let me read the disclaimer first in Spanish, okay, and then in English. Sabéis que invertir como profesional DRACO TV no representa un servicio de inversión, no ofrece ningún servicio de inversión o servicio auxiliar, tampoco ofrece asesoramiento financiero o de inversión personalizada y cualquier opinión o análisis expresado aquí por el formador, por mí, pues es siempre con carácter totalmente educativo y en ningún caso representa una recomendación de inversión. Let me read in English for a moment. The mention of any security in this session does not constitute an investment recommendation. Investors should always conduct careful analysis themselves or consult with their investment advisors before acting in the stock market. Steven, we may have positions in any of the securities referenced in this session. Okay, Steven, what we think for this interview is to separate the interview in 3 parts. The first one is the idea is to know more about Steven. Who is Steven? How is your trajectory from the first day that you decide to try to start to invest or to be interested in the stock market and today? And then the second part, we can check your investment style. I recommend an article because Steven is so active in social networking. So I discovered Steven when he was in Seeking Alpha, writing articles. And right now, I think you are in Substack, you are in Twitter, and you are in Smartkarma. No? I think most of them, this is the 3 social networks that I can read you. But I think that the last article that you write in Substack, I think it's really good, and you can use that for the second part because you are talking about all the attributes that you think you are following your investment strategy. And then for the end of the interview, the third part, you can talk about your ideas or any names, and we can discuss about these names. Okay? So
Sounds good.
If you want to start with some introduce about who is Steven.
Right. I mean, so my investment career from the inception. So basically, in my view, I don't differentiate between investing in a business and operating a business or managing a business, in the sense that both jobs are to allocate capital, right? So this brings me back to maybe around 7-8 years ago. I decided to start up my own company in the exciting and fast-growing tech sector, technology sector here in China. So I founded my company, and then I co-founded another one, and some other smaller business thereafter. And it just, this experience, this entrepreneur experience, just enabled me to reach the conclusion that investment business is the most beautiful business in the world, in my view, for me. So that's why I decided to move towards the investment side for my career. By the way, so there's a lot of similarity and some differences. For example, so when you're running a startup, you have to be always cautious about the trend, right? Over the short term, right? I mean, startup, like, the failing rate is pretty high, almost 95% here in China. But I mean, with the right investment strategy, you know, we can partner with very high quality business to invest in, and that can produce a lot of predictable results compared to, you know, running a startup yourself. Of course, there's some other beauty about investing in a business with the right approach, by the way, versus running your own business as an entrepreneur. I mean, we can dig deeper later.
Could you talk a little bit about when you start to analyze companies, when you start to trade for the first time? So maybe when you have, I don't know, 16, 17, 15?
Hello?
Can you hear me?
Yeah. You said 15, 17.
No, I'm asking you if you can talk at the time when you start to analyze companies or when you start to invest. So the first time, and which kind of stocks you are looking at that time.
Well, yeah, basically I look at the same thing as if I was trying to run the business, right? So the business economics matters the most. For example, return on capital is probably the most significant goal or target or indicator about the healthiness of a business, right? And you don't want the business to have a lot of debt, right? Because that just incur a lot of downside risk over the long term. And you hope for you would hope for the business to produce predictable results. So how can we do that? For example, some business, they have a high portion of their revenue generated from recurring activities, right? So for example, those SaaS enterprise software companies, they charge a subscription fee on a monthly basis or on an annual basis. So that can be really a plus for investors, right?
Steven, let's delay these attributes for later in the interview if you want. So my idea is to try to talk with the people about who is Steven, to talk about your person, right? So you are living in China, so you are from China. So can you talk a little bit about what's your day-to-day there, and then we can move to your investment strategy?
Well, so my day-to-day job is to analyze companies. So usually in the morning, you know, I check emails I read news, and I spend most of the time reading annual reports, reading regulatory filings about the company we invest in or we are interested in, right? And I guess probably 10% of the time we'll talk to the management team, because we try to find kind of underappreciated names that are probably ignored by other investors or Wall Street analysts. So we would like to, get to know more about the business, get to know more about the management team. So we spend some time talking to the company management team. It can be founder or CEO, CFO, or just IR specialist of the
Steven?
company. Yep. Hello?
Connection. Steven, can you hear me?
Yep.
Okay, sorry. I think we have some problems with the connection. Okay, let's go to the part 2. So the idea with this second part is to talk about your investment style. I repeat, so I recommend people to go to the Substack of Steven Chen. I think the name is Seeking Alpha for the Long Term, right?
Hello? Hello?
Steven. Bueno, parece que tenemos algún problema con la conexión, disculpar, pero estamos en directo desde Shanghai y a veces las cosas no siempre funcionan. A ver si se vuelve a conectar Steven. Bueno, a ver, ¿tenemos alguna pregunta? Steven, I think we have some problems with the connection.
Can you hear me?
Yes, I think we have some problems with the connection. Okay, we can try again.
Can you hear me now?
Yes, I can hear now, but I don't know why we have some problems before. Okay, try again. Okay, let's go to the second part. I read something in your article that I think sounds interesting. You said that the stock market is a second-order system, and you think that it's not the future events that matters, that what matters is the consensus view regarding these future events. Could you explain about that?
Right. So for example, let's say if you can predict, let's say 2 years ago, more than 2 years ago, if you can predict what's going on over the past 2 years, I mean, the once in a lifetime global pandemic, right? That's one thing, and the subsequent, disruption to the supply chain, the border closure, and a heavy burden on our healthcare system worldwide, right? So if you and let alone the war going on right now, right? So if you could have predict all those, what would you do in the stock market for the next 2 years? So some investors will think it's rational to just sell and stay out of the stock market, right, as quick as possible, right? But it just turned out the market went up for 2 consecutive years, right? So I mean, it's in the end, it's more of people's perception, people's view about all the macro events matters instead of the actual impact of the events, right? So I listed that a viewpoint back in the middle of last month when the stock market kind of plunged day after day. So I just try to point out it's almost useless to time the market according to macro news and macro events.
Okay, let's go to detail your investment style. You talk about, I think, let me check, 8 or 9 different points. And the first one, you said that you look exclusively for high quality companies. And you talk that a high quality company is a company with a high return on cash and a healthy balance sheet. So for your quality company, this is your screen to a quality company, or also you are using different kind of qualitative attributes like quantitative and qualitative. So how you describe a quality company?
Right. So simply put, a high quality company is a company that can generate consistent high return on capital over time, right? And that high return should not be based on a high financial leverage, right? So the business itself, without much use of debt, can itself generate a very high return on the capital they invest into the business. So that can be one of the metrics we use at Hillside to screen for new ideas. But that's not the only one, because sometimes the accounting just need to be adjusted. Because, for example, so we have one case where before the IPO, there was a major merger of two companies to establish one company which was going IPO. So there was a lot of goodwill on the balance sheet, which lowered the return on equity, return on assets at the moment, but it keeps improving, right? So if we adjust for that huge amount of goodwill, the business itself generates very high return on capital. So that's one thing. Another adjustment is so the accounting earnings. So let's say, where's the cash, right? So the question is, where's the cash? So some earnings, they look pretty high, but it's not very cash generated, right? And some other companies, their return on capital looks relatively low, but if you use free cash flow, just the free cash flow instead of earning, you can come up with a conclusion that they generate very high return on capital in cash earning, right? So that can be, I mean, these metrics can be used in a screener, but oftentimes we find the need to adjust it.
Steven, we have problems with the connection. Maybe you can disconnect the video and only stay with the audio. That's possible.
Okay, let's try that.
Maybe it could be a solution, or well, now it's better, but I don't know why. So your picture, your measurement really well.
Right. Stop. Okay, how about now? Okay. Is it better?
Yeah, let's try. I think could be better. Okay, Steven. So a quality company is a company that generates superior cash on return capital, but I can remember many companies that they have a return on invest capitals, I don't know, 40, 50, 60%, but this is the past. So where the market's looking is to the future. So is it possible that companies in the future they have more competition, so more competitors, so the return on invest capital goes down? So how do you manage this problem?
Right. So and that comes to the part of their competitive advantage, right? So the competitive advantage can help to keep away competition and to help retain their customers, right? So we need to gauge whether the competitive advantage is sustainable, right? So Warren Buffett used this word, it's called moat. So basically, it seems it's a sustainable, durable competitive advantage. So I think that's because in my view, so investing is not only about science, it's more about art. So I think that comes the art part of investing. So we need some analysis, mostly qualitative rather than quantitative analysis of the business, so that we can make sure that its competitive advantage can sustain in the long-term future.
Do you like?
I mean, how about the voice quantity right now? Is it better, or because I can try something else, by the way?
I think it's better. Yeah.
Okay.
If you want, you can try to open again the video, and then if it continue to fail, we can switch off your
right. Because right now I'm using VPN, so sometimes the VPN kind of interfere the voice quality. But just let me know if the quality is still not good, then I can turn off the VPN.
So people that was in the live tell me that right now the audio is really good. So if you want, try to open your video and we can check again.
Okay, let me see. Okay,
let's try. Okay, it's clear what is a quality company for you. Then you told that you are looking for business that are shareholder oriented, so where there are skin in the game, where the management, where there are some insider that has a big stake in the company. So also you prefer companies with a family founder behind the company. So could you explain here?
Right, because usually you know it's really rare for us as outside investors to work alongside the management team, and for a year maybe we can get 1 hour meeting or maybe 2 1-hour meetings with the management team. So within that limited time frame, if we try to gauge the quality of the management, it's really tough to do, right? So one quick trick we can try to gauge the quality of the management is actually the incentive of the management, right? So usually first thing we check about the company is the proxy statement to see how many shares they own, and we determine we can try to see if they really work for the money, for the wage, for the salary, or for the share, right? So for example, if the founder still own, let's say just hypothetically 1 billion USD worth of share, and his salary is just hypothetical number, it's let's say 10 million, right? So usually the share price can go up over the long term for these predictable high quality companies. So we can understand that the main driver for the management team is to generate shareholder value instead of to getting paid, right? Getting paid by cash, by the way, right? So that's kind of like a quick way we can really check the management's the real intention, right? So normally we favor companies that are owner operated, and preferably it's still led by the founder.
What do you think about companies with high stock-based compensation? Maybe 10% or more than 10%, and that percentage is not decreasing, so it's increasing year by year. So how do you treat this line in when you value the company? Because, for example, in my case, I like to exclude, not to include again when I compute my free cash flow, because US GAAP and IFRS, they can add again the stock-based compensation. So what's your opinion here?
I'm sorry, your voice had been cut a little bit.
Yes, so I like to know your opinion about the stock-based compensation. So when the management is paid with options. So
that's a really good question, because especially tech company, they pay a lot, right? And you don't see that over the line of free cash flow, right? So we normally use what we call adjusted free cash flow or owner's cash earnings in our term, and we deduct the operating cash flow. We deduct the share-based compensation from the free cash flow. So we exclude that.
So you exclude. You are not adding this line, right?
No.
Okay.
No.
And
it's basically the cost. It's basically the cost, but the business just delay that cost to a future date.
And you are looking at metrics like which percentage is the CEO salary against total revenue or against total employees,
right?
Or this kind of metrics.
Yeah, that's also a very useful way to gauge the shareholder friendliness. So usually we hope to see the CEO's total cost, total pay represents way less than 1% of the adjusted earning we come up with, less than 1% of the earning. But there are some exceptions. So for example, for smaller companies, so for micro cap companies, their earning base is relatively low. So it's really difficult to hit that target. So sometimes we make some exceptions. But usually, normally, like mid cap, large cap, definitely below 1%, far below 1% of the earnings.
Okay, and last question here. When you see a stock-based compensation that the main metric is the growth in EPS or the growth in sales, so do you like that, or you prefer metrics like a return on invest capital, ROE, ROA? So which metrics do you like to view when you invest with high insider ownership?
Sure, I know where you're going. So we would like to see a balance between growth and a return. So if they would like to achieve a high return on capital, maybe they just will be too conservative in terms of deploying new capital. So they can maintain this high return on capital year in and year out, right? So we invest in a company called Constellation Software. It's one of our largest holdings in our portfolio. And the management's KPI, I believe, is growth plus top line growth plus return on capital employed. So we need a combination of both.
Okay, this company, Steven, is really known here in Spain. I think many retail investors and professional investors follow that company, and many of them are shareholders of Constellation. Right. I think the track record is really amazing. Yeah. Let me the last one related to stock-based compensation. So do you like companies where the management or the owner or the CEO has 60-70% of all the shares? Do you think this is a risk or not?
Okay, so if they have 60-70% of all the shares, then basically they control the company. So our preference is between hopefully higher than 15, below 50. And if they control the company, then I mean we're neutral about it. I mean it's still one of the many factors we look at it. So if they control the company, we need to check their track record in terms of how they treat minority shareholders in the past.
Okay, we have some questions, but I prefer to answer you later, right?
No problem.
Another attribute that you are looking for boring business. No, it seems that you love boring business.
Right.
So what do you understand for boring? So stock price that move in lower than the market, like they has less standard deviation, or a business that anyone is looking at that business because I don't know the analyst coverage is really small. Is it a micro cap? So what you're referring here for a boring business?
Right. So it's mainly about the nature of the business, probably the sector or industry of the business, right? Because for example, we follow a company called Rollins in the States. It's in the pest control business, And
which one? Sorry,
Rollings.
Rolling. Oh, okay.
In the United States, and they are in the pest control business. So they own a leading market share, and the market is really fragmented in the States. So they can consolidate, doing a lot of acquisition, a lot of bolt-on small acquisitions to gain market share while grow retail revenue, and maintain a relatively high return on capital. I mean, we don't own it, but we follow it. It's quite expensive at the moment. So borrowing business, so usually it attracts fewer competitions, right? So just think about, let's say a technology company, technology giant, and you are one of the manager walking in the boardroom, and they propose that we enter the space of a pest control. I'm sure the conversation will end quite quickly, right? So it's too boring, right? It does not attract outside investors. Most outside investors, it does not attract any attention within the boardroom, right? And also it attracts less attention from the regulators, right? So another business we follow, we by the way, we don't own it, is Chemet, also in the United States, and I believe one of its subsidiary, which is the plumbing business, serving over 50% of the U.S. population. So we cannot imagine that the U.S. regulator will give a speech and saying, hey, this is a monopoly, and we have to we have to take actions, increase the regulation pressure in this sector, in the plumbing sector, right? Because it's boring. So we think the boring business are generally prone to less, a relatively low level of competitive pressure, and usually, and by the way, hopefully it gets ignored by many of the investors at the same time.
Sorry, have you talked about plumbing business, right?
Yeah.
Because last week I discovered a new company, because I always searching for companies with franchise revenue, royalties revenue, like the same that you like, that we talk later about recurring revenue. And one of that was, well, one of my first position in my fund was Water Intelligence, who is a franchise business that has business in the US, or it trades in the UK, but has business, maybe 90% of the revenue comes from the US. And it is a boring business, and it's a micro cap. I think this is one of the smallest companies of my portfolio, but it's a boring business because his business is leak detection, right? When you have a leak at your home and you have to unleak the water, so you are calling to Water Intelligence in the US, American leak detection. So, but last week I discovered franchise brands, who is not the same business, but it's plumbing in UK, and it's the same. It's different three or four franchises where the plumbing was the main contributing to revenue, and I think it's boring business, so it's most of the same. I think it could be interesting for you, right?
Yeah. Does it generate high return on capital?
It should, yeah.
All these companies I'll check that out. Okay, great. Okay.
Okay, so we talk about high quality companies. We talk about skin in the game, founded, lead the companies, shareholder oriented, boring business. That is really good. The fourth one, it's you told that you are not trying to predict the future winners. You concentrate who has the market share today, right? Who are the winners today, not in the future. So I suppose that you are not investing in high growth companies, like, I don't know, CrowdStrike, Teladoc, Roku. What do you think about this kind of high growth, this kind of style investing?
Well, I mean, I guess borrowing business can I mean, some of them can also grow at a rapid pace. And some of them can generate really high margins and really good business economics, right? So basically, by the way, so speaking of prediction, so versus, for example, who will win, for example, the metaverse space in the long-term future. I mean, we could do that, but versus that, it's relatively, we think it's relatively safer to just concentrate capital in those across those players who have already won and keep winning. I mean that, but that idea also does not exclude those rapidly growing companies, right? So one example I have here, and we do own the share, is Evolution Gaming, which is a Swedish technology company in the online casino content space. So people said, what is the largest casino in the world? It's not those offline operators.
It's online.
It's online, but it partnered with offline operator to provide those online games for those operators to acquire players to play. And they do like a revenue sharing scheme between the operator. Operator can be offline and online, and Evolution Gaming, right? So, but I mean, this is good example. So the space, the online casino space is growing at probably 20, 30, or even 35% every year recently, right? And Evolution Gaming in Europe, they capture a 70% market share, 70 market share. And their market share in the United States has recently opened up due to a change of regulation. They own almost 100% of the market share, right? And this market is growing rapidly. And Evolution Gaming is the top player, grow alongside the market. So it also can increase the revenue by a very high percentage points every year, right?
Okay, in your article, you talk about National Beverage. This is a company that I look at some time, but
right.
I have problems because I don't like too much companies that has brands, but I cannot, like, I don't know if that brand is going to sustain in the future, because people can change his taste about that beverage. So can you talk a little bit about National Beverage?
Sure. So National Beverage own one sparkling water brand called La Croix, or some people pronounce La Croix. So that beverage brand is one of the most Instagrammable. So it's a new word, Instagrammable beverage name among younger generation in the United States. And that category is growing at double digit, right? So if National Beverage can maintain this leader status of that category, so it is supposed to grow at double digit as well, right? But we'll see, right? So you mentioned brand, so brand can produce some loyalty across consumers. I mean, as long as they can earn a significant position on the top of their mind, but on the downside, there's a risk of the brand being a fad, right? So it's like you can grow really quick, but in the end, the brand power faded, right? So I mean, so in that regard, we acknowledge this is a possibility. And we try, I mean, according to this possibility, we try to control the weight of the position we have in the share. That's one thing. And another thing is we will probably have a relatively lower valuation estimate regarding the total business compared to some other business that we think will have a wider moat.
Okay, great. Then you told that you underappreciate market leadership. So what means that?
Right. So so we find, I mean, so last year, we find good entry point for us to establish a position in national beverage. The share looks pretty lowly rated compared to other beverage names. And it's interesting when we talk to the management team, they said they never, I mean, they are not interested in talking to sell side analysts. They are not interested in talking to Wall Street communities, and they don't even organize earnings call. So it looks like they try to focus on the business instead of communicating to shareholders. So to us, this may cause some underappreciation of the company among investment community, right? So we would like to take advantage of that. And another example is also last year. So there's a company in Hong Kong. It's called Plover Bay. You probably never heard of it. It's a micro cap according to probably according to American standard. It's below 1 billion USD in market cap. So it's in the networking, the SD-WAN networking space. It's not a leader in the SD-WAN. So by the way, SD-WAN is software-defined wide area network. So basically, it's a technology to enhance the performance of the network as well as lower the cost of the network, right? So in that total market SD-WAN space, Plover Bay is probably number 4 or number 5, right? So Cisco, all those big players, then they are top players, right? But the management made a right move a couple of years ago to enter the wireless SD-WAN space and establish a leading market share over there. So according to our estimate, so in the wireless segment of the total market, by the way, the technology is different between wired and wireless. Wireless is mostly rely on 5G, right? And in that niche space, they earn a 20% market share. They're the market leader at the moment, right? Okay. And by the way, we talk to the management often, and this is one of my favorite questions. So what are the market are missing, right? Or what do you think is Mr. Market misunderstanding about your company? So one explanation according to the management, it's possible, but we don't know whether it's true or not. Is usually when investors look for technology investment, they don't look at Hong Kong. It's a Hong Kong business, but it's a global business, right? They don't sell to Hong Kong. They don't sell to mainland China. They mainly sell to the United States. It's a global leader, but it's based in Hong Kong. And if you screen all the technology name, you probably ignore Hong Kong. I mean, you probably think banking and food about Hong Kong, right? Not technology, right? So that's an interesting explanation from the management. Okay. Why they are underappreciated.
Okay, great. Steven, could you try to talk without your voice? Because it's really noise. So could you try to take out your voice?
Okay. Let me.
Let's try, and is it better you should to open your voice there. Ahora le pasaré preguntas cuando acabemos con esta parte. ¿Vale? Las estoy guardando todas y le preguntamos. A ver si podemos conectar el auricular. Steven? I cannot hear you. Take again your voice. A ver, un momento. Si me ponéis las preguntas en inglés, se las pondré directamente en pantalla. ¿Vale? Repito, cuando acabemos con esta parte, quedan 3 o 4 puntos, le paso las preguntas antes de entrar en nombres. Could you open the micro, Steven?
Can you hear me now?
Now, okay. No, now, okay. Now it's okay.
It's good?
Yes. I think it's better.
Okay. Okay, all right.
Okay, so you told that your margin of safety is to invest in companies with low debt, with that they have a revenue that it's predictable, they have recurring revenue. What do you think? So are you searching for franchises, royalties, long-term contracts? What do you understand for recurring revenue here?
Right. So so recurring revenue can help enhance the predictability of the business, right? So for example, like as mentioned earlier, SaaS software, enterprise software providers, they charge monthly or annually, annual subscription fees, and it's really hard for the client to get rid of their software, right? As long as their client exists. And also another example, I think it's in the restaurant space. So usually we tend to avoid restaurant because it's usually same margin. It's not juicy margin, and it lacks scalability in our view. It lacks a moat in our view in typical situation. But some restaurant are able to franchise out their brand to franchisees, right? So they can collect the payment from the franchisees ahead of the opening of the new restaurant, and they can grow alongside their franchisees, right? So when the franchisees they earn more revenue, they have more commissions out of those revenue, right? So they're saying, I mean, what can be better to use others' capital to grow your own business, right? So that's a description for the restaurant franchises.
What do you know about Domino's Pizza, MT Foods, restaurant brands, this kind of companies? So did you like it?
Yeah, I like the franchise aspect of the business model, but
Not in restaurant.
I'm sorry?
Not in the restaurant industry, right?
Right. I mean, so for example, Domino Pizza, Wingstop, I mean, they have very solid business model, which is to franchise out their brand around the globe. But I think for us to say no to those businesses because of their financial leverage, right? They have a negative equity on the balance sheet, so that's our concern. We do own another name. It's called Snake Empire. By the way, can you hear me clearly now?
Yeah, it's okay. Could you repeat the name of this company?
Sure. The name of the company is a Snack Empire.
Snack Empire. I think it's in Hong Kong or Singapore, right?
It's confusing. I think that's why it got a underappreciated status. So Snack Empires operates a Taiwanese street food brand. They are headquartered in Singapore but listed in Hong Kong, right? So sometimes it confuses people. Should it belong to a fund in Hong Kong for Hong Kong equity, or for Singapore equity, or for Taiwanese equity, right? So it's an interesting company. So Snake Empire. So as I mentioned, they employ the franchise model outside of Singapore. So they directly operate their restaurant, their shops within Singapore. And their value proposition is highly differentiated in our view. So it's kind of a combination of a fast food concept with Oriental flavor, right? Think about the Domino Pizza of the Far East, of Taiwan, let's say, from Taiwan, let's say, right? So and they are asset light because it's it's a franchise model mainly, and their brand power is solid. And just think about it. So what kind of brand can attract franchisees, right? It must be a well-known brand, right? And according to the founders, so they don't do like B2B franchising marketing. So most of the franchisees find the food really good, and they come to the companies and say, hey, can we have a franchise arrangement in our region, right? So right now, outside of Singapore, which is their home market, they are also in Malaysia, they are in the United States, in California, they are even in regions like Egypt and Cambodia, right? So it's all over the world right now.
Okay, I'm really focused in the restaurant industry because last week I'm doing a YouTube video talking about Pershing Square and Bill Ackman. And if you look the portfolio today from Bill Ackman, it's a lot of restaurants like Domino's, Chipotle, restaurant brands, these kind of things. And because I think they are hedging against the next recession, I'm going to pass you some questions that I think could be interesting. You can read in your screen, but also I'm reading. The first one is from JC. Said, "What is the best business that you ever came across with, independent of the price?"
Wow. I think if I look at our portfolio, so I mean, I think most of the top holdings, if not all of the top holdings, we think they are great business. So Constellation Software is one. They generate high return on capital, very disciplined capital allocators. They can find a way to deploy incremental capital to generate more returns, right? And they focus on the VMS, so vertical market software segment. So usually the product has a very high switching cost, and they have a high retention rate for their product. It's still founder led. So my colleagues will probably describe the founder as the greatest capital allocator in the world. And he doesn't think it's Warren Buffett. He thinks it's the founder of Constellation Software. So it's good management team. I think that's one.
I think Mark Leonard is a follower of Warren Buffett and value investing, right?
I'm sorry?
Mark Leonard, I think it's the CEO, right? So the name of the CEO of the Constellation Software, it's Mark Leonard, I think.
Yeah. He's.
I think Mark is a follower of the value investing and Warren Buffett.
Right. Yeah. He's. I mean, he's still lead the management team at least. So that's one. So recently we established position in Games Workshop, which is a UK company, developer, the so-called Warhammer games. I don't play the games, but I see a lot of fans across the globe. So basically they create the IP, they create their own market, which is the Warhammer world, and they keep recruiting new fans across the globe. So they can. So they have the moat. So we think they have a wide moat. That's the first thing. They generate high return on capital. That's the next thing. And they can deploy new capital. They can deploy incremental capital to generate additional free cash flow at very attractive rate of return. That's what's about the third thing. So in their annual filings, every year, you will see a line saying their goal is to generate, one of their goals is to generate very high return on capital employed, right? So we get excited by the line, but we would like to, it would best for us to get clarification about the high return. So how high is a high return on capital employed, right? So we ask management, they say 100%. So their target is 100% return on capital. Right, but I'm sure they cannot deploy all their retained earnings, or all their earnings, right? They pay out a sizable dividend, but they still deploy a good portion of their earnings every year to try to generate that 100% return. right? So, I mean, just think about it. If it's just cut in half, 50%, still very good, right? So they don't have debt. They can grow their business worldwide. I think that there's a new shop here in Shanghai coming up this year, hopefully after the lockdown. And they keep launching new business, right? So one of their new businesses is a royalty business. So they license out their IP to video game developers to earn royalties, right? So it's very asset-like, right? So I think it's also it's also one of our high conviction names in our portfolio.
Okay. I discovered one company reading your newsletter. I recommend all the people that was connected to this live to read the monthly newsletter from Hills Wealth Management. I think it's really good. So there are different people talking, but I think if you are searching for new ideas, I think this is a good place to reach and to find ideas. And I discovered one. I don't like the cyclical sectors. I don't like the commodity sectors. I never invest in energy, deep materials, these kind of things. But I discovered one company who is Texas Pacific Land Corporation that, okay, his customers is it deep cyclical companies, but I think the business is totally different than to be an exploration or manufacturing or something like that. So could you talk a little bit about that name?
Right. So Texas Pacific Land Corp. So they used to be a trust, recently converted to a corporation. So they own a very precious land in Western Texas. So what's good about that land? It produces oil and gas. It produces energy, right? So they own the royalty rights of that land, and they don't need to invest in the capex to produce those oil, right? So there will be energy producers like Chevron. So they invest in the infrastructure, in the capex to produce those oils, and Texas Pacific Land Corporation, they charge commission, they charge royalty fees on every oils they got out of the land they own, right? So it's very asset light. And I just checked the stats over the weekend, and they have, I mean, compared to other resources in the United States, their resources is the most economic. Meaning the cost for the energy producer like Chevron to produce the same level of revenue is relatively low in Western Texas compared to other regions in the United States. And there's a trend that the US would like to go, energy independent. So maybe in the foreseeable future, there will be more activities in the land over the Western Texas. And if that's the case, they can grow their revenue for the long term.
Which one is the main risk for this company, Steven?
Yeah, that's a good question. I mean, they have the land. The land is the unique resource. It's the unique differentiator, right? It cannot be easily replicated. We are seeing that there has been some fight over the quality of the corporate governance with the management. So maybe that's one of the risk factors. But other than that, this is asset light, and they have the unique resources. They don't have any debt. Yeah, if I have to pick, maybe it's the management team, maybe.
Last week, I'm buying a small stake in that company. I always try to buy something, a really small portion, and then I try to make my due diligence. But I think it's really different to the typical energy or materials stock, right?
Yeah.
Okay, more questions. SNF ask about, is it important the size? So are you investing in micro small caps, only mid caps? Because I think what you like is a mid-cap company, right?
Well, okay. So regarding the size of the company, we find usually smaller company interest in the end, because the smaller the company, the less popular it is among the investor community, and also it has a longer growth runway, right? So we usually find more attractiveness within the smaller segment across the spectrum of market cap.
Are you investing in the OTC market?
Right. I mean, OTC market, I guess, as well as alternative investment market in London. So because we are licensed in Canada, so there's some restriction in terms of investing in OTC and the AIM listed shares. But I mean, we do have some kind of unrestricted account that we can invest, but it's not a big area that we focus.
Okay.
But
We have more questions.
I acknowledge that there should be more efficiencies in the OTC and the AIM markets. For that, I'm sure.
I always said that 99% of all the companies that trade in the OTC market are trash, as same as Leonardo DiCaprio talks. But the other 1% is something that you should look,
Right.
because when you have something amazing inside of the trash, you can
Right.
you are not looking at that company, right? I think this is because it's interesting. More questions, Steven. Do you know Haidialio chain food brand?
Yeah.
So
Yeah, I mean,
GC talk about, what's your opinion here?
right. Okay, so it's one of the largest hot pot restaurant chains here in China. Well, I mean, it's very famous. It's well known, especially for foodies. But I think it's an easy pass for us at Hillside because it does not generate consistently high return on capital, so it's an easy pass. But the brand is well known.
So you like that?
We like to be its consumer instead of its investors. If that answers that question.
Okay.
The food is really good, but the service is really good. If you're here in China, you should try it.
Okay, we have here another one question, more generic, from China. What's your thoughts about China's market with low valuations, with the government regulation uncertain? What do you think about Baba, Tencent? So could you talk a little bit about that?
Right. Okay. So China market. So some people. So some of my friends, when we talk over the phone, and most of them are from overseas and they living overseas. They say, hey, because you are right now in China, you're in Shanghai, and your portfolio must have a lot of Chinese name over there, because you have the information advantage. And usually I told them back that because of those advantage, relatively advantage, if any advantage I have regarding the Chinese business. Because of that, we don't have any Chinese companies in our portfolio. And actually, we have a strict exposure limit to in terms of our portfolio company sales in China. The reason is we don't think the Chinese market. I mean, the Chinese market is truly exciting. I'm sure it will grow over time, but it's not very predictable in our view. That's one thing. And also the other thing is regarding Chinese companies. So the typical situation is they don't have a very high quality corporate governance and transparency according to our standard, right? So it's really good. We are running a truly global portfolio. So we do not compare one Chinese company to another Chinese company. We actually compare Chinese company we're interested in from business perspective to the company we're also interested in outside of China, right? So if we compare at that level, usually we'll pass on. I would never say never, but we haven't found any Chinese company that we think can consistently earn high return on capital, and also with evidence of shareholder-friendly management team.
Steven, do you used to talk with the management? So for you, is necessary? For example, in my case, when I'm investing in a micro cap or a small cap, I'm always want to talk with the management, and then I like to contrast the information, talking with customers, suppliers, or competitors. What's your approach here? Because there are investors that say, okay, I don't need to talk with the management because the CEO people are brilliant people. They know really well the company, and they can lie in you because they know better than you the company. What do you think here?
Yeah, I mean, we try to talk to all related parties, right? So not only management. So if we have the chance, we would like to talk to previous employees, for example. We like to talk to the competitors. We like to talk to their clients and suppliers, and maybe also a sales side analyst covering the company, right? So we would like to try to build a comprehensive view, comprehensive, objective, rational view about the company. So if we can get a call of the management, we usually do not want to lose that opportunities. So we do want to talk to the management. And by the way, so this is in terms of style. So we truly focus on the global scene, not only for the region, not focus on Chinese, not only focus on Canadian companies. So for example, so in some regions, and by the way, our approach is bottom up. So for example, if we find a really interesting company in Japan, and we really would like to understand the industry in Japan, which I'm sure it's quite different from the same industry here in China or same industry here in the United States. Right? So
it's really difficult, Japan. So
that's right.
I never invest in Japan because I'm in this job for 21 years, and I used to call, send emails, send letters to to Japanese companies, and I'm be able to talk with the management from Japan. This is the reason because I'm not investing in Japan, right?
Right. I mean, so I guess language barrier is an issue. I mean, if we become interested in a company, so we would like to leverage all the resources we can. So sometimes we have the situation that we have to hire interpreter to join the conversation, just make sure we get the message right. And some in other cases so in case they cannot accept the interview request, we email back and forth. So there's one company we followed, and we didn't have a meeting, but we probably send 15, 20 emails with all kinds of questions to the management team, and follow the story for more than 4 months before we make the decision, right? So there needs to be some hard work involved. And we hope those hard work can pay off in the long term. Right, but I hear you. It's really difficult to get a meeting with Japanese companies management team, and usually culture difference, language barriers are kind of the issues here.
Okay, more questions. Do you know Beijing Chunslin Handa? Well, you can read better than me here. Do you know this company?
No,
I think one of these is a technology medical device company. I think the first one. I'm not sure, but I think this is one. And this is a really profitable business with, but I think there are competitors there. Okay, let's talk about so we talk about many different qualitative aspects about your investment process. But what about valuation? So are you computing a price target? Are you forecast the P&L, the balance sheet, the free cash flow of the company? What you are doing for valuation?
In terms of valuation, right? You said
Yes.
valuation. Okay, right. I mean, yeah, valuation is usually the last step for us after we analyzed all the business aspects of the company. So we do DCF, but we don't try to be very precise in terms of the assumptions over there, right? So we don't argue, let's say, 1% difference or even 2% difference in terms of the growth rate. So usually we have a relatively conservative assumption that kind of produce a margin of safeties in terms of the end results. So that's one thing, DCF. And we compare the valuation across industry and across history, right? And I indicate earlier, so we have several disciplines in terms of the exposure limit. So for some relatively high risky regions, we adjust the discount rate. Usually we have a pretty high hurdle rate for the discount rate for the DCF, but in case of some regions, we have a even higher discount rate to compensate for the potential political risk or maybe currency risk.
Okay, when you are computing your forecast, for example, in terms of revenue or in terms of cost, are you using the consensus numbers? Are you using percentage of growth? Or, for example, in my case, I love to compute unit economics. So, for example, if I'm analyzing Starbucks, I'm not projecting a 10% revenue growth and 5% or 20% EBITDA margin. I prefer to project the number of new restaurants in franchise segment, in the own segment, and then to do the same with cost. So are you using unit economics for some kind of...
Yeah, I mean, so it depends on the business we try to calculate the valuation of, right? So yeah, I mean unit growth, if that's the driver of the future growth, that's definitely a very important aspect. And we try to basically, for the assumption, we list key factors for the future growth, right? So that includes units, right? So for example, in terms of restaurant, and for each factors, if we project, let's say 5 years out, 10 years out, 15 years out, so in the end, we would like to have those end numbers make sense in terms of, for example, market penetration rate or market share, right? So we cross-reference those figures and information.
Okay, we have one question, which one of your other parts in your article. Do you pay attention to macroeconomic events? So, for example, there are consensus that next year the US economy is going to be to recession. So, at Hills Management, are you changing your portfolio because the US economy is going to be to recession or not?
That's really a good question, and I can say we pay almost zero attention. So let me take a step back. So the reason for our strategy, which is to invest in high quality business, is, so first of all, it's really difficult to figure out the trend, the short-term trend, right? And then those business actually benefits from economic downturns, right? Why is that? Because the recession usually wipes out competition. It wipes out the weaker players, right? And we don't invest in turnaround. We don't invest in average business. We only focus on the truly great, truly good business out of the global stock market, right? So that's the reason. I mean, we can afford to ignore this really difficult problem, which is to predict what's the economic situation for the next year, or maybe even for the year after, right? So that's one thing, and also you know, another frequent question we got asked is, do you see if the market crash is coming? Right, that's not related to the economics, but you know, to the stock market, right? So if the volatility goes up right now, I mean, let's say right now the volatility stay relatively low. What if it goes up? And actually, it benefits our company as well. Why is that? Because our company invested company has cash problem. It's the cash problem on the upside, it's not on the downside. They don't need cash. They actually produce too much cash year in, year out. And they don't need a lot of capital expenditure to sustain their operation. They probably don't need to invest a lot of cash to sustain their growth, right? So where can they deploy their retained cash, right? So dividend is one, but you know, there's a taxation on dividend. Another way is share buyback, right? So actually, we investor, by definition, all investors are long term, 5 years out, 10 years out, right? We would actually hope for the market volatility to go up, so they can have additional way to deploy their cash. We would hope for, as previously mentioned, I mean, we don't hope for economic downturn, but we know if that happens, they will benefit from the downturn from a shareholder perspective, to gain market share, to enhance their market leader status.
Your portfolio in Hills Wealth is a long equity portfolio, or is a portfolio of different mix of assets?
Well, it's so we have three portfolios. So one is pure equity, the other one is 70% equity, 30% fixed income, and the other one is more conservative. It's a 50-50 split between fixed income and equity.
And is it a hedge fund, or is it a mutual fund?
So
people can invest there?
We do long only.
Sorry?
It's a long only fund. We don't short, we don't hedge, and we don't buy derivatives.
Yes, but the question is it a fund, or is it a portfolio for customers?
Well, technically, it's a segregated accounts, and customer open accounts with us, and
so
we manage.
Can I invest in that portfolio?
Well, you know, I'm not on the sales team. There's some regulation. I'm sure there's some regulation over there. I think we can accept international investors, but you know, because I'm not the guy to you know, talk about, you know, on the sales side.
Okay.
Just shoot us an email. Maybe I'll leave our website URL here.
Okay. Here there are some questions related that you are from China and you are not really confident with the stocks here in China, and the question is, okay, so you think that you cannot find value today in China?
That's right. I mean, okay, so we focus on quality first. So if the business pass our quality criteria, then we discuss the valuation, right? So valuation only matters when we find a high quality company, and we haven't find any. I haven't find any high quality companies compared to all the options we have globally. Not yet. I mean, we do have some invested companies listed located in Hong Kong. So Plover Bay, you know, as previously mentioned, that's one in the technology space. Another company called Perfect Medical, which is the largest medical beauty chain in Hong Kong. Yeah, I mean, we look at Hong Kong, but not mainland at the moment. We haven't found anything interesting from mainland.
Okay. Okay, we don't have more questions. I think it's 1 hour and 20 minutes live, and I know that it's late right now in Shanghai. So, Steven, many thanks for your time. I continue to read your newsletters from Hills Management. I recommend all the people that was connected to read these newsletters. And maybe in the next quarters, we can set up a new video call and you can talk about how is going your holdings or new ideas.
Sure. Yeah, no problem. I mean, I hope you guys enjoy the conversation here. Yeah, and I'm sorry about the quality of the voice. You know, I know it's kind of a long distance here. Maybe that's the issue. So and also thanks for the opportunities, and I'll see you in a little while.
Okay, see you, Steven. Bye.
Yep, see you. Have a good one.
Bueno, pues aquí hemos tenido una entrevista con Steven. Bueno, la conexión no ha sido muy buena, hemos intentado solventarlo, yo creo que al final ha mejorado. Pero bueno, creo que ha sido muy interesante porque Steven, como veis, sigue muchos negocios, negocios de calidad, globales, tanto grandes como pequeñas compañías. Yo lo conocí hace muchos años a través de su perfil en Seeking Alpha, pero la verdad es que es muy, muy interesante. Os recomiendo que lo sigáis en Twitter, que lo sigáis en Smartkarma, que es como un Seeking Alpha en Asia, y que lo sigáis en las newsletters de Hills Management, ¿vale? Porque creo que aporta mucho valor, conoce bien las empresas, habla con las empresas y define y encuentra muy bien lo que es el concepto de calidad. ¿Vale? Espero que os haya gustado este directo. Recordar, como os he mostrado a lo largo del vídeo, que quedan 5 días para que empiece la segunda edición del curso avanzado. Así que si queréis subir vuestro nivel de valoración por las nubes y mejorar pues, el rendimiento de las inversiones, pues os invito a que os matriculéis ahora, aprovechando las últimas plazas y los últimos días disponibles. El curso empieza el 18 de abril, ¿vale? Aunque te puedes matricular pasados 2-3 días, pero se va a cortar la inscripción pues pasados 3 días del día 18. Espero que os haya gustado este directo, nos despedimos y nos vemos la próxima semana en un próximo directo de Invertir como Profesional, DRACO TV y entrevistas DRACO TV. Un saludo y suscribiros al canal si no lo estáis. Hasta luego.